to my lecturer Sir Shahiru. Today, me and my group mate would like to present subject of financial analysis for chapter 1, 2, 4, 5 and 6. I will explain about chapter 1, Introduction to Financial Management. So firstly, we must know the definitions of financial management. Financial management is that managerial activity which is concerned with the planning and controlling of the firm's financial resources. Next, the goal of an organization is to maximize the shareholder wealth through maximizing the price of the firm's common stock. But why maximization of shareholder wealth is a prefer over profit maximization as the objective of a firm? This is because of the time patterns of the returns. Even a large return is expected 20 years, every shareholder will wait that long to get the first returns for the project. Next is risk. If a financial manager aims to maximizing the shareholder wealth, he will consider the risk involved because the risk the project undertaken, the market price of the stock may be less. After that, because of a dividend policy, firm which aim only to maximizing the profit will never pay dividends. However, when earning increase accompanied with payments of dividends, it would impact the value of the stock. In chapter 1, we also know about functions of financial manager. Here the functions: 1. Performing financial analysis. 2. Financial forecasting and planning. 3. Financial decision. 4. Making investment decision. And 5. Asset management decisions. Next, we must know about definitions of financial market. Financial market is marketplace in which people buy and sell financial assets such as bond, equities, and derivatives. It can be divided into two markets, namely money market and capital market. Money market is a financial market to raise short-term financing with high liquidity being trade. Example, treasury bills and commercial papers. Capital market is a financial market for buying and selling of long-term debt and equity securities. This market can be divided into primary and secondary markets. Lastly, in chapter 1 is advantages of financial institution to the financial market. The advantages is reducing the time and cost of transferring funds and reducing the risk faced by the investor and savers.
I will explain about chapter 2, depreciation and taxation. Depreciation have two parts. Firstly, annual depreciation or AD is annual allocation of a cost of an asset over its useful life. It is a non-cash expenses. Secondly is accumulated depreciation or ACD is the total allocation of the cost of asset from year 1 until the present year. Depreciation will reduce the book value of an asset. There are three methods of depreciation. First, straight line method. Second, double declining balance method. And the last one is sum of the year digit method. On straight line method, we'll have the same annual amount of depreciation or AD throughout the useful life of the machine. Secondly, on double declining balance method, the rate applied is twice the straight line rate for the depreciable asset. Adjustment is needed if the asset is not fully depreciated under this method. Lastly, on this sum of the year digit method, annual depreciation is greater in the early years than the later year, and the salvage value is deducted from the cost of asset. For taxation refers to action of taxing authority impose a tax, and also individual and corporation must pay tax on any income derived from their activities. There are two types of taxation. Firstly is corporate income tax. It is imposed on ordinary income, operating income, earning before tax, or taxable income derived from business operation. Secondly is capital gain tax. It is imposed on capital gains or profit when a firm sells asset more than original purchase price. However, the proceeds from sale of asset has impact on cash flows. It creates either the tax liability or tax saving. Tax liability increases the amount of the tax that corporation has to pay to a taxing authority. Tax saving is arise if firm incur losses in business operation or capital loss. In taxation, also use the same method with depreciation to find the tax liability or tax saving. Okay, next I will teach you for this past few questions. The first question is determine the cost of asset. Formula cost of asset is price plus other costs, which mean installation cost and transportation cost. The price is 90,000 and the other cost of transportation is 10,000. So the total cost of asset is 100,000. Next, determine the annual depreciation in the third year based on the sum of years digit method. First, find the sum of digit or COD. The formula is useful life plus 1 multiply useful life and divide by 2. Next, formula annual depreciation is remaining useful life divide by COD multiply cost of asset minus salvage value. The answer is 16,000. Next question is determine book value in the third year based on sum of year digit method. Previous video I show you the schedule to find book value. You must follow the schedule to get the answer. The answer is 36,000. Next question is determine the taxable earnings. Taxable earnings is same with earnings before tax. The formula is earning before tax multiply corporate tax rate. The answer is 15,000. Next question is determine recapture depreciation after tax. First, calculate the profit for see the amount loss or profit, because if profit then calculate tax on RAD. The formula of profit is selling price minus book value and then take the lowest amount between profit and accumulated depreciation or ACD. The formula for calculate RAD is profit or accumulated depreciation multiply corporate tax rate. The last question is determine the total tax liability. The formula is tax on RAD plus tax on EBT plus tax on capital gain.
I will explain about Chapter 4 Risk and Return Relationship. Risk is the potential of unexpected events to occur, while return is the rewards we expect to get from investment. So what the difference between the risk and uncertainty? The first one, risk. Probabilities of outcomes that can be estimated or known. Uncertainty, probabilities of outcomes that cannot be estimated or not known. So there are three categories of risk preference investor. Number 1, risk averse investor. Number 2, risk indifferent investor. The last one is risk-seeking investor. Types of risk. Number 1, specific risk. Number 2, non-systematic risk. So don't waste our time. Let's do a question. So here is the question. So determine the expected return, variance, standard deviation, coefficient of variation, and which project should be taken and why. Expected return is probability times return. So we need to calculate all of these. Probability is 35% times the return. The return is 45,000 equals to 15,750. Next one, we need to calculate for the average condition. 40% times 18,000 equals to 7,200. Okay, the last one is bad condition. The bad condition is 25% times to 7,000 equals to 1,700. So we need to total up all of these to get the expected return. So the expected return for the project Hazierah is 24,700. Expected return of project Beza is 30,000. So let's calculate the variance. Variance is probability times return minus expected return. 35% times 45,000 minus the expected return 24,700 square equals to 144,231,500. The average condition is 17 956,000. Bad condition 78322,500. So total of all of these, so we get the variance is 240,510,000. So the variance of the project Beza is 411,000,000. The next one is standard deviation. Standard deviation is square root of variance. Root 240,510,000 equals to 15,508. Project Beza, square root of 411,000,000 equals to 20,273. Coefficient of variation is standard deviation divided by expected return. The standard deviation of Project Hazierah is 10,508 divide 24,700 equals to 0.63 times. The standard deviation of the Project Beza is 20,273 divide 30,000 equals to 0.68 times. Which project should be taken and why? Based on the calculation, Project Hazierah should be chosen because it's less risky and since it has a lower standard deviation and coefficient of variance.
I will explain how to do calculation of the chapter 5, which is cost of capital. There is a 9 step. For the first one, the sources of capital for company are coming from the following: long-term financial securities such as bond or debt, preferred stock and common equity. After that, calculate the cost of long-term financial security, which is KB, KBAT, KP, KC and KRE. Then calculate the book value weight of each sources of financing if the weight are not given in the question. And after that, find the breaking point. Furthermore, determine the range of financing based on the breaking point following which with ascending order and calculate for the descending IRR and calculate the accumulated cost. Last but not least, you have to plot the graph and choose which IRR better or WMCC. I choose one of the past year question for the chapter 5 and I will explain how to answer the question. For this question, we need to find breaking point, WMCC for each range of financing and construct the WMCC curve and conclude in which project to be accepted. First thing first, we have to calculate the cost of capital and arrange each cost according to financing limit that given in question. For the cost of capital for bond interest of 240,000 and more than that, it is 10.5% and 30.25%. Meanwhile, the preferred stock interest of 100,000 and more than that, it is 11.46% and 11.96%. Besides that, the common equity is divided into two, which is retained earning is 12%, while common stock is 50%. After that, we need to calculate the book value weight of each sources of financing, which is weight for bond is 150,000 divide 500,000, so we get 30%, while the weight of preferred stock and common equity is 10% and 60%. By the same way of calculation weight of bond, for the breaking point of bond is 800,000, meanwhile the preferred stock is 1 million and the breaking point of the common stock is 200,000. Rearrange in ascending order of financing based on the breaking point. However, there are 4 range of financing, which is the first financing range is 10 ringgit until 200,000 and the WMCC for this range is 11.496%. Second financing range is 200,000 until 800,000 and the WMCC for this range is 30.296%. Next, the third financing range is
800,000 until 1 million, and the WNCC for this range is 40.1 to 1%. For the third of financing range is more than 1 million, and the WNCC for this range is 40.171%. Then you have to arrange the project according to descending IRR and calculate the accumulated cost. For the accumulated cost of project C, B and A, it is 90,000, 150,000 and 161,000. So the company should choose project C and B because all of them have the IRR bigger than WNCC. So that's all from me. Thank you.
So I would like to present about chapter 6, which is operating leverage and break-even analysis. Based on this topic, there are two indifferent alternatives, which are degree of operating leverage and break-even analysis. The definition of degree of operating leverage, DOL, is the percentage changes in EBIT resulting from a percentage change in sales. There are three formulas of operating leverage. First one is DOL equal percent change in EBIT divided with percent change in sale is to find the expected level of operating income for the next year. Next formula is DOL equals sales minus variable cost divided with sales minus variable cost minus fixed cost is to calculate the firm's degree of operating leverage. Lastly, DOL equal to X, open bracket, P minus V, close bracket divided with X, open bracket, P minus V, close bracket, minus F is to find the operational leverage at the sales level. Moreover, the definition of break-even analysis is a method used to determine the level of sales that a firm must reach to cover its operating costs. Break-even happens when operating income is equal to zero, which implies that sales revenue are equal to costs. Therefore, in break-even analysis also has three formulas, which is for a question that asks about break-even point in units, we will use the formula F divided by P minus Y, while to find the break-even in RM, BEP in units multiplied by P, and the next question that asks to find the sales target or profit, we will use this formula, which is F plus profit and divided by P minus V. Okay, let's look at this example 1, and the question is Bandar Berhad produced television which sells for 1,500 ringgit per unit. Variable cost per unit of phone is 400 ringgit and the fixed costs are 20 million ringgit. First, we need to calculate the profit or loss if the sales level at 30,000 units with using this formula, and you will get 13 million ringgit. Next, the calculation of break-even point in units. You will use this formula, and the answer of the calculation is 18,181.8182 units. Third question is to calculate the break-even point in ringgit with this formula, and the answer of the calculation is 27,222,727 ringgit and 30 cents. Last question is how many televisions the company should sell for the target profit of 15 million ringgit with using this formula, and the answer of calculation is 63,636.36. Next, for the example 2, the question is Najiah Golf has decided to sell a new line of golf clubs. The clubs will sell 750 ringgit per set and have a variable cost of 330 ringgit per set. The company has 151,200 ringgit fixed cost per year. So first, we need to calculate the break-even point in quantity with using this formula, and the answer is 360 units. Next question asks to calculate the sales break-even in ringgit, and you will using this formula, and you will get 270,000 ringgit. The last question is how many sets of golf clubs should be company sales in order to achieve 300,000 and 300 ringgit of profit. So the calculation is 151,200 plus 300,000 and 300 divided by 750 minus 330, and you will get 1075 units. Okay, that's all from me and my groupmate. Thank you.